Triangles are one of the patterns that I consider when I'm looking at my charts, and they are one of the most popular chart patterns in technical analysis. And I want to cover the different types of them and how you can trade them. And I'd also like you to hit subscribe and give a like if you enjoy the video, which I think you will. Anyways, consolidations. That's what the triangle is considered, and it's generally a continuation pattern. The price gets tighter as the swings in price get smaller, and this tightness indicates lower volatility. So the good thing is that as price coils, it builds, quote, energy, and when the triangles break, they can be explosive. And the general rule of thumb when you're trading any breakout from a triangle, do not attempt to fade that break, because you are dealing with a market that has undergone range contraction, and the moves from these patterns can often never look back. And there are three forms that a triangle pattern is going to take, and as with all chart patterns, they're not always going to look picture perfect. The symmetrical triangle, that can either be a continuation or a reversal pattern. We have the ascending triangle, and that's considered bullish, where the higher lows are made as a triangle forms. And the descending triangle, and that's bearish, where the lower highs are made during the formation. So the symmetrical pattern, this triangle is tricky, as the prices don't really tip the market hand how it's going to break out. So we can expect either continuation of the current trend or a reversal. So the first leg, it appears to be a normal impulse price move, with the down leg being the corrective decline. So if we consider an uptrending pattern, we fully expect the higher low to be put in place. And the tip-off of a potential triangle forming is when we fail to make a new high. Price then puts in a price structure that no longer resembles a trending price structure, when that is uptrends, and they are higher highs and higher lows. Downtrends, they're lower highs and lower lows. A symmetrical pattern, it violates the trending price structure. And I want you to notice as each price swing in the asset meets opposite pressure, the swings will actually decrease in size as price heads toward the apex. And the apex is where the two ends of the trend lines are going to meet. So trading these triangles are tricky, but there can be times where price will give a hint to the breakout point. Generally looking for longer shadows or failure tests of the support or resistance, it can be enough to convince a trader to place a trade. Placing a trade before the breakout, they can often lead to quick gains when momentum finally does take over. And failing that, traders can use the techniques such as bull flags, bear flags, other triangle patterns, ranges to place a trade after that breakout happens. So I want you to keep in mind that false breakouts can occur to trap traders. So I want you to always ensure that you use proper risk management when you're trading any strategy or price pattern. And due to the nature of this pattern, using below support or above resistance levels for stops can be difficult because of the sloping nature of those levels. So in those cases, I want you to consider maybe an ATR type of stop loss or below the widest portion of the triangle. And when you're considering price targets for profits, a rule of thumb is the height of the triangle pattern at the widest point projected from the breakout point. And traders will also use the breakout direction just as confirmation of a trend direction, including a reversal. And with that, they would use their own tactics to trade the market. The ascending triangle is bullish, and traders would expect an upside breakout point through the resistance. So the main features of this pattern is successive higher lows into a defined resistance zone at swing highs. The higher swing lows, it shows that buyers are stepping in to buy the asset at higher prices, and that would be a bullish scenario. But what's vital to understand is even though buyers are unable to bring prices higher over the resistance level, the higher lows will tip the odds to an upside breakout. And many traders will position prior to the breakout during the swing low portion of the formation of the ascending triangle. Let's talk about horizontal ranges for a second. There's going to be times when markets make the horizontal range where both the support and the resistance zones are tested. And trading inside of ranges can be pretty painful, but we can use the ascending triangle to give us an indication of the potential breakout point. So after multiple tests of support, finding an ascending triangle inside of what was a horizontal range, it adds to the upside breakout point. So traders can position inside the triangle with a stop below the lowest point of the triangle. So this will have traders positioned before the breakout, which can lead to fast upside gains without playing the actual breakout, which can often lead to slippage. And we are also able to avoid large losses if there's a failed breakout, because we would already have some profits in the trade. The descending triangle pattern is going to show a pattern of lower highs into support where the swing lows have been rejected. So the inability of sellers to bring price lower does not negate a downside breakout, as the lower highs are showing selling at cheaper prices. The lack of upside strength is the defining feature of the descending triangle. Price coils as the lower highs are put in place while the lows remain in roughly the same general area. So traders can position after two swing lows or use the break as confirmation of the trend. So the descending triangle can also be used in the horizontal range as we just talked about. So let's wrap it up. It's pretty simple. Even though these graphics show an idealized depiction of the triangles, it's the concept that matters in relation to the evolution of price, where swing highs and lows into the support or resistance zone, the coiling feature of the triangle pattern, the bull and bear battle that takes place, trading the triangles in horizontal ranges. That may need traders to use a slightly lower time frame, especially when you're using the higher time frames. Using the triangles to position before the breakout of the range, I gotta admit, it's a favorite trading technique of mine. And like any trading tactic, triangles and their breakouts, they fail. And it's important to understand what the failure is for a triangle. And that would be sudden momentum coming in and wiping out the higher lows for an ascending triangle, for an example. So the triangle pattern, I think it's another tool that you can use to define the market state that you're in. Using your own tactics upon the breakout or trading the pattern itself is something that I think a lot of traders should take a look at. Thanks for watching.